Hello, this is Linda Hitt. We're going to talk about different ways to record and price out and cost inventory. So this is looking at wholesale prices and the fact that when you purchase inventory from your supplier, you may pay different unit prices, maybe not each time, but some of the time. And therefore you need to figure out when you make the sale what the cost of goods sold will be. So first, let's look at two acceptable methods for the U.S. rules, LIFO and FIFO. And when we do these methods, we do actually leave separate unit prices in the calculations. First in, first out assumes that the older prices, the first goods purchased, or those costs, will be used for the first goods out, or those sold. Thus, in inflationary times, the older prices would be the lower prices for cost of goods sold. And ending inventory would then be the last purchase prices or the newer prices. This is usually going to yield you the lowest cost of goods sold and the highest profits on the income statement and also the highest ending inventory on the balance sheet. This method is logical, it's popular, it's acceptable by the international group. So it's a very highly used method, and it's logical because often companies sell their goods, try to rotate and sell the older units first. But it's not the best method for tax purposes. It's not going to give you the lowest tax break if there is inflationary times. If we compare this to last in, first out, which is a U.S. method that is not accepted in the international group, this particular method works just the opposite, where we assume that the most recent prices are used with cost of goods sold, giving us the highest cost of goods sold, and the ending inventory then tends to be priced at the older prices, which with inflation would be the lower prices. So this one usually has the highest cost of goods sold, lowest profits, and the lowest ending inventory, which is why it's a good tax method. If you get a large cost of goods sold deduction, expense deduction, it's going to yield the lowest taxable income. But unfortunately, the IRS has the legal right and has decided that if a company chooses to use the last in, first out for the tax return for tax purposes, it has to also use that for their income statement and balance sheet and so forth. One of the disadvantages of this method is if it's used over time, and many companies will tend to keep a certain constant level of inventory, not the same units, but a certain number of units, that the ending inventory over time can contain very old prices that go back, when that company first went into business or when it first started to use LIFO. So that is a disadvantage of this particular method because it will tend to understate ending inventory, which is an asset on the balance sheet. Other methods we can use, weighted average, though not used as highly as LIFO and FIFO, is acceptable with U.S. and international. And the nice thing with it is the cost of goods sold in the income statement and the ending inventory in the balance sheet will use the same unit costs. So we don't have, the high and the low or the old or the new. It's a blend of the costs. The disadvantage with this method is every time new units are purchased, it usually requires that you re-average and recalculate the average unit. So there are sometimes rounding errors. You may have to carry your unit price out 4 or 5 places. Specific identification is not really exactly the same kind of thing as a strategy, but if you label every unit you sell with a wholesale price, you can actually then tell what you paid for that particular can of goods or whatever you're selling. It tends not to be a method used that often, particularly if you have low-priced, high-sale items. It's just easier to use a strategy like LIFO, FIFO, and weighted average. And it's possible to manipulate your cost of goods sold and maybe lower cost of goods sold by selecting units that you purchased at a lower price. So it's probably not as highly used as the other methods. Once you've selected a method, one thing we do have to look at, if you change from LIFO to FIFO or FIFO to weighted average or whatever, it would actually change your profits. So companies have to be consistent year after year. Now, if they have different kinds of goods, maybe you're a parent company and you own 3 subsidiary companies. Each subsidiary could use a different method, or even the one company could use it with different product lines. So, sometimes companies will use more than one method, but not for the same goods. Also, it can be used for other types of things, like if the company buys investments in stocks and they pay different prices at different times for the same stock, then this could be used there as well. Because it's difficult to compare companies with different inventory methods, companies using LIFO actually require a footnote to help an investor, compare a company using FIFO with a company using LIFO, where it allows them to kind of figure out what the profits would have been had they used the other method. One of the big things that we do want to recognize is that you do not have to use a method that actually fits with the way you physically move and sell and handle your goods in your store. So, for example, a grocery store could be selling more on a FIFO basis and rotating the old merchandise. They do not have to use FIFO for their books and for taxes, and they can choose to, but they don't have to. So, and actually I should have said LIFO for books and taxes. So anyway, basically you can use any method. Any of the 3 methods, or any of the 4, I should say, are acceptable, and it does not have to tie in with anything you're doing. So next we're going to go ahead and take a look at the problem that we have to work out. And we're just going to do a few transactions. So we have a beginning balance in inventory of 100 units, 10. We don't have to journalize that. That's been done before. You can see the subsidiary cost card. We have the 100 units at 10. The general ledger, of course, would also show the beginning balance. So the first thing we're doing is buying units. This is all taking place in January. So 1,000 units at 12. I know you can do that. It should be $12,000. And we're going to assume that we're purchasing them for cash. So we're going to pick up inventory at 12, and then we're going to credit cash for 12. And then we're going to come over here and look at the impact on the statements. And if we think about this, one asset's going up and one asset's coming down. So it's definitely an asset exchange. No impact on the income statements until you sell it. And for cash flow, we see that it's an outflow of cash. And this would definitely be operations. This is what you do on a day-to-day basis. The inventory cost card would need to be updated since we debited inventory. So we pick up the units, the unit cost, the total dollars, and I need to pick up 12, don't I? And then over here, the ending balance would be, and I'm going to repeat the beginning. When we do LIFO or FIFO, and we're going to address those first, we need to keep the layers separate. So I'm just going to bring across 1,000 units at $12, and we'll leave the beginning layer there as part of the results. Okay, if we then purchase more units, we again deal with inventory. I'm just going to bring that down. And the cost would be, we're buying 500 units at 15, so that's $7,500. So we're going to put that in. And then we're going to look at, same impact on the statement, so I won't bother to show that. But we're going to come over here and put in 500 units at 15 for a total of, I'll do the calculation. Actually, we just did the calculation. How quickly I forget. So that's going to be $7,500. And then I'm going to bring that across as 500, 15, 7,500. So the ending balance is really all of those units, 100, 1,000, 500, which I could have repeated each time, but I just chose it's just easier to leave it like that. When we make the sale, and let me update the general ledger. All the cost cards added together should equal the one balance in the general ledger. So we had the beginning balance, we added $12,000 in the first purchase and $7,500 in the second purchase. So that's updated. Okay, now we make the sale. We sold $1,500 units at $30. So if we take 1,500 times 30, that's what we're charging the customer. We're going to get cash for it, so that's $4,500. 45,000, I guess. And it's going to simply be cash and sales revenue. So this is the retail side of the transaction. If I can spell it. There we go. The impact on your statements you're going to have, and I'm going to do it with the numbers. We can compare it in a minute to the other part. Why didn't that work? Okay, so we're increasing assets by $45,000. Sales revenue is a retained earnings account. It's a temporary account. So when it closes, it'll increase stockholders' equity also by $45,000. And your net income, of course, is going to be better because we have a revenue. So again, we're going to increase it by $45,000. And then for cash flow, same deal. An increase by $45,000. Whoops, I hit that down. $45,000, and of course that's part of operations. Okay. I'm not staying in my lines here. Okay, here we go. So I don't need to update the subsidiary cost card. In fact, I want to point that out that the inventory cost card does not include anything about retail. If you want to show retail price, then write it up at the top in its own little separate spot. But when you look at sold, that's cost of goods sold. And it may be good to emphasize that. It's not the selling price, it's not revenue. Okay, when we make the sale, we're going to go next to the second entry. So we've taken care of the customer in the retail. Now we're going to look at the using up of inventory. So if you remember, assets used up become an expense. So cost of goods sold expense is our title, and inventory is the asset that's going to be decreased. So now we're using LIFO, FIFO, weighted average, one of those methods to help us figure out what the cost of goods sold is. And we have the data in front of us with the inventory cost card. Here are all the different unit prices we have to work with. So with FIFO, first in, first out, I sold 1,500 units. I need to figure out the cost of those 1,500 units. If I look over here, I find that the oldest prices is where I need to start. So if I come over here to cost of goods sold, come down to the units, 100 units at 10 is $1,000, and I need 1,500 units. So I'm not anywhere close. In fact, if we do the calc, we obviously see 1,500 units needed in the sale minus 100 that's used, and we can only use $10 for the 100 units that we have. So that means I need 1,400 more units. And if you look, I've wiped out the first layer, the old layer, but the next layer's got 1,000 at 12. So I need all those units. So if I pick up 1,000 at 12, now I have 1,100. So 1,500 total units minus 100 minus 1,000 gives me 400 units left. So of the last layer, I'm almost wiping out that layer, but 100 units are not needed, and that must be ending inventory. So I'll pick up 400 units at 15, and we'll figure out the cost of those. 400 times 15 is 6,000. And so what that leaves me with, as we figured out, is 500 units minus 100 from the last layer gives me 100 units in ending inventory, costing $15 a piece, which is the most recent price. And so I have what? Well, I could do the math. Let's just show it. 100 times 15 is $1,500. Okay, so if I use first in, first out, then I would be taking, I need to total these up to figure out my balance over there. So I have 1,000 plus 12,000 plus 6,000. So $19,000 is my answer. So all that work goes to do the one journal entry over here, particularly if I can get the numbers right. Okay, here's 19 then as a credit. Okay. What impact does the cost of goods sold have on your statements? We can do this one. We would reduce our assets, right? We have less inventory by $19,000. Cost of goods sold as a retained earnings account is going to cause retained earnings to go down as an expense by $19,000. And your net income with an expense is going to go down. And there's no cash. Cash happens whenever we purchase and then pay for the goods. So we can see that in this particular situation, our profit, or gross profit rather, on this transaction is the $45,000 retail price minus the $19,000 wholesale price. So we've made $26,000 if we use FIFO. So the inventory we've updated in the subsidiary ledger, hopefully. I'm not sure what that is. Let me take that out. So we got the $1,500 of 100 units. So in the general ledger at the end of the period, we would have the $19,000 coming out of inventory, moved to cost of goods sold, and the ending balance for inventory, if we did the math, should be, and I think it does work, to $1,500. So but your general ledger and your subsidiary ledger should agree. Most of the time you have a number of subsidiary ledgers added up to equal the general ledger. So that's FIFO, and not to confuse us, let me see if I'll just hide FIFO. I think I can just do that since we've got Excel here. Okay, and I will back out of general ledger for a minute, that number. And then let's try the same thing, but this time we're going to do LIFO. So we still have an expense and we have an asset going down. Okay, we need to figure out the amount. So really the cost cards is the place to look to get that data. Certainly not back to journal entries, and I will wait on the impact on the statements. So over here we've got the 3 different levels, 3 different layers, and we sold 1,500 units, and this time we're going to the last unit and use that first. So the most recent units purchased would be the 500 at 15 or 7,500. Obviously we don't have enough. 1,500 units sold. We've just used 500 and wiped out that layer, so we have 1,000 units left. If we look to the next most recent, we do have 1,000 exactly. So we're going to need all 1,000 of that layer. 1,000 at 12,000. Okay? And the last ones that we didn't use is 100 at 10. So that becomes your ending inventory. And you can see why with LIFO that's a problem, because the beginning inventory is now the same dollar figure as the ending inventory, and then next year's beginning inventory will be this year's ending. So that $10 can be moved forward year after year if you keep approximately 100 units, give or take. Okay, so then I can come back and put in, I need to do that math, don't I? 7,500, we're simply adding those together, plus 12,000 is 19,005. Okay, so cost of goods sold is a little bit higher with LIFO. I guess that, obviously if we have a large dollar amount of goods, it's going to be a bigger spread. But if that's the case, then I would reduce my inventory by 19,500. Cost of goods sold would go up by 19,500. And what you'd be left with, hopefully, is $100 $1,000 rather, in ending inventory that would again agree from the general ledger to the subsidiary, and the $19,005 would be on your income statement. So the impact on the statements would be that your assets go down by $19,005. Your, your stockholders' equity would go down because of the expense. Let's do it that way. And your profits would be less. And there's no cash flow. Okay, so that would be the situation for LIFO, and you can see again why that gives a better tax break, because you have a larger expense deduction. Next, let's see if we can hide LIFO, and we'll do weighted average. Weighted average, same account titles, of course, that we picked up before, but we then need to do the calculation. So that's what, again, we need the strategies for. So this one's going to blend everything. Because it is different, we're actually going to go back and redo this part of your subsidiary ledger. So let me put in the beginning balance for inventory in units and dollars. And then what you're going to do is when you made the purchase of 1,000 units, we're going to put the 100 units together with 1,000. So units to units. Add what you have already plus what you're buying. And so we have a new layer of 1,100. So we're going to actually blend everything together. Then leave the unit cost blank for a minute. And now let's do the dollars. We had $12,000 in our purchase, and we have $1,000 already in beginning inventory. So 12 plus 1,000 is 13,000, hopefully. Last time we checked. Okay, and once you get to this point, now we need to figure out the unit price. So to figure out the unit price, I'm going to take 13,000 and divide it by 1,100. Whoops. My number lock must have come off. Let me try that again. So we have 13,000 divided by 1,100. Of course, nothing, this is again the disadvantage of weighted averages, that it never comes out evenly. You have these big old long numbers. So you do have a rounding error. So $11.82. How about that? Give or take. 82. Okay, and then we again bought more units, 500 at 7,500. So once again, take the most recent total cumulative amount of units, which is 1,100, which we just saw, and then add the 500 units. So now we have 1,600 units. Okay, we're not going to figure out the unit price last, then go to your dollars. So we have right now 13,000 total there in inventory, and we're going to add the cost of the second purchase, which is 7,500. Whoops, I lost my calculator. 13,000 plus 7,500. 20,500. And then once again, to figure out the unit cost, we do a division. So hopefully we can pull this one off. So 20,500 divided by 1,600 units is 12.8125. So I'm going to put all of them in there. 12.8125. And so again, you may have to carry it out a couple places to try to limit the rounding error. So over here, I don't have to look 50 places. That's the one good thing. When I deal with my, well, before I can actually put that over there, we need to do the sale. So 1,500 units at 12.8125, and we can do the calculations. 1,500 times 12.8125 8125 is 19,218.75. 19,218.75. Okay, and that leaves you with 100 units. In all cases, you always have the same number of units left. The unit cost will be the same for the ending inventory as it was for cost of goods sold. And then we do the last calculation there. So 100 times 12.8125. 1281.25. Okay. So we have that information. Now we can figure out, and we don't have to add a whole bunch of stuff up. We have it right in front of us. So the other nice thing, again, is it's all, when you do the cost of goods sold entry, there's not all these layers to deal with. You've already dealt with that when you re-averaged after each purchase. Okay, so there's the cost. And just like before, your assets, your stockholders' equity, your net income, everything would go down for that amount. I'll just put 219. Oh, but not liabilities. 19,219. And I'll change that. So this one falls between, the cost of goods sold falls between LIFO and FIFO. If you can see, we had inflation. Our price went from 10 to 12 to 15. So clearly the prices are increasing, and FIFO gave you the lowest cost of goods sold. LIFO gave you the highest cost of goods sold, and weighted average fell in between. So that hopefully, and I didn't really update this, but your general ledger, of course, would go down by the that number for cost of goods sold, and your ending balance would be what we're showing in the subsidiary, and then your cost of goods sold would be updated for the new figure. So again, the 3 different methods give you different results, and that's why you have to be consistent in the usage.